Well, we're ending the first quarter with tantrum without the taper. And I'm thinking that the worst is probably behind us right now. In the second quarter, we're going to have very strong growth numbers. We do think some of this inflation overshoot will materialize as well. But a lot of this price movement has already occurred. I mean, you have most fixed income markets that are in negative territory right now. I am thinking that there are some opportunities, though, outside of the U.S. I mean, you have triple the vaccines that are going to be delivered in Europe in the second quarter of the year. And you've had this weakness in Asia where we think that some of the worst could actually be behind us.
Michael, you worried about some of the big outperformers of last year. We could call them the ARC complex, perhaps, which was down the ARC ETF 2.4% today. Is there more downside to come for some of those names?
It sure looks like it. And I would just point out that the market is at an all-time high, but we would much rather see the high momentum names lead us as opposed to, say, Procter & Gamble, which all of a sudden is looking like a momentum stock. But I just want to point out that it's so easy to get lost in the day-to-day gyrations of the market. But if we take a step back and think about what drives the economy, which is consumer spending, 70% of our GDP is consumer spending. If we and everybody is expecting an economic boom to materialize, then it's hard to get too bearish on the stock market. And if this is just a pause where the high flyers, the Apples and Amazons, which have done nothing, especially Amazon and Netflix for 7 months, if they could come out of their bases and join the rally and join the participation, that could set us up for the next leg higher. Absent that, I think you're putting a lot of weight on the materials and the industrials to continue to carry the rally.
Jim, I just want to riff off of what Joyce just said about this taperless tantrum. Do you see it the same way? I mean, what is your expectation for the 10-year Treasury yields, for example, through the rest of this year? Is the worst, or at least that fast pace of increases that we saw that was so violent and quick, is that type of movement behind us now?
I think largely it is. You had all these concerns last month about the supplemental liquidity ratio being ending on March 31st, and that the questions about whether the banks were going to have to sell treasuries, and maybe they did sell treasuries throughout the month. I know most of the selling in treasuries came through the Japanese session, and their quarter is over now, and I don't think we're going to see that much pressure on yields moving up from here, at least not at that rate. So what does that mean? It probably means less excitement for the financials, although we do like financials. They probably are going to be a little less robust, and I think we're going to see a lot of rotation. I think Michael is right, though. If you look at what's happened with the NASDAQ and the intraday trading of the NASDAQ, we've been closing week on a pretty consistent basis. The semiconductor index was leading the market all of last year. Now it's real choppy. Unless we can get some direction out of the NASDAQ, out of the semiconductors that were our leading growth areas, it may be harder to push these other areas much further because the industrials, the materials, and the financials have all had big runs. And so that's why I'm saying we may see a little bit of trouble for the averages, but we will have markets of stocks inside those averages. There will be rotations. There will be stock pickers and their ability to make money above what the indexes are doing. So I don't think we're going to fall out of bed here. I just think it's going to be a lot harder moving forward and a lot more selective. I like this better than I like that.
Joyce, what will rise faster in the next 6 to 12 months, yields or earnings?
Well, we have yields rising to 1.95 for the 10-year by the end of the year. But I don't think that level of rates is really problematic for the equity market. So I think a lot of this momentum trade has already unwound. Now, we still like value more here, but I would think that momentum here could perform in line. Some of this energy sell-off also that we've seen over the last few weeks seems that it is not fundamentally driven. So some of the energy equities still look attractive as well. So there's going to be a rise in yields, but I do think that we've seen a lot of the big move behind us. And I don't see a level of rates that's going to be overall problematic for the equity markets when we look out 6 to 12 months.
Shepard Smith here. Thanks for watching CNBC on YouTube.